Financial risk is the possibility that an investment's actual return will differ from the expected return, often resulting in a loss. It arises from many sources: market movements, borrower defaults, operational failures, legal setbacks, and affects individuals, companies, and entire economies. Understanding the types, measurement tools, and management techniques helps decision makers balance opportunity and protection. Market risk stems from changes in prices, interest rates, exchange rates, and commodity values. Equity prices fall, interest rates rise, or currencies swing. Each can reduce asset values or increase liability costs. Credit risk is the chance that a counterparty will fail to meet its obligations. It applies to loans, bonds, and derivative counterparties. Liquidity risk occurs when an asset cannot be sold quickly at a fair price or when funding sources dry up. Operational risk covers losses from failed processes, systems, or people, fraud, cyber attacks, business interruption. Legal and compliance risk arises from litigation, regulatory changes, or contract disputes. Systemic risk refers to the potential for a problem at one institution to cascade across the financial system. Measuring financial risk combines statistical techniques, scenario analysis, and expert judgment. Value at risk, VAR, estimates the potential loss over a defined period for a given confidence level and is widely used for market risk, though it has limitations in capturing extreme events. Stress testing and scenario analysis probe how portfolios perform under severe but plausible conditions, revealing vulnerabilities that normal models miss. Credit risk is assessed via probability of default, loss given default, and exposure at default. Credit spreads and ratings provide market-based signals. Liquidity risk is evaluated by funding profiles, market depth, and bid-ask spreads. Qualitative assessments, control reviews, audits, and root cause analyses are essential for operational and legal risks. Managing financial risk requires a mix of prevention, mitigation, and transfer strategies. Diversification reduces exposure to any single risk source, but cannot eliminate systemic or correlated shocks. Hedging with derivatives, futures, options, swaps, can lock in prices, rates, or currencies, though hedges introduce counterparty and model risks. Robust credit underwriting, collateral arrangements, and netting agreements lower counterparty exposure. Liquidity buffers, cash reserves, committed credit lines, and liquid asset holdings help withstand funding stress. Operational risk management focuses on controls, redundancy, employee training, cybersecurity, and incident response planning. Insurance and securitization transfer certain risks to third parties. Capital adequacy, holding sufficient equity or loss-absorbing instruments, provides a cushion against unexpected losses. Governance and culture are as important as technical tools. Clear risk appetite statements, well-defined limits, independent risk oversight, timely reporting, and incentives aligned with long-term outcomes create an environment where risks are identified, escalated, and managed. Communication between frontline business units, risk teams, and senior management ensures that risk-taking is deliberate and informed. In practice, effective risk management is dynamic. Models are updated, scenarios refreshed, and policies adapted to shifting markets and regulations. Simple principles: know your exposures, quantify what you can, prepare for the unknown, and maintain reserves guide resilient decision-making. By combining measurement, controls, capital, and culture, organizations can pursue growth while keeping downside risks within acceptable bounds.